Committee on Banking, Housing, and Urban Affairs will come to order. Apologize to the witnesses and to the observers today, both in person in the committee room and those watching remote for the delay. Senator Scott and I were at a briefing. We won't talk about any more than that on what's happened with China and what's happened with the balloons that military and others have protected us from, if you will. So we needed to stay and at least hear the generals make their remarks to us. What a difference a year makes. Go back to last year's Super Bowl. The cryptocurrency industry spent a whopping $54 million on 8 ads promising Americans untold riches and the chance to make history. Of course, they didn't tell us about the high fees, the risk of loss, the outright theft that plagued the crypto industry. But if you watched the Super Bowl 2 nights ago, you didn't see a single ad for crypto. The cryptocurrency industry has imploded in 2022. The crypto market lost $1.46 trillion. That's 1.46 thousand billion in value. Hackers and fraudsters, often tied to the regimes in Pyongyang and Moscow, have stolen over $3 billion. Crypto firms have slashed over 1,600 jobs. And as crypto values crashed last year, platforms began collapsing, creating more losses across the rest of the crypto ecosystem. The crypto firms that are left have had to halt customer withdrawals, freezing people out from their own money. While crypto contagion didn't affect the broader financial system, thank God, we saw glimpses of the damage it could have done if crypto migrated into the banking system. The handful of banks with close ties to the crypto industry have needed liquidity lifelines after they suffered large withdrawals. This crypto nightmare isn't over yet. We're still learning the full extent of the fallout from the FTX collapse. In December, this committee heard about the excessive risk-taking and misconduct at FTX. The customers who lost money are only now understanding the reality of the products they were sold. As these crypto firms filed for bankruptcy, regulators and policymakers have also learned how out of control some of those businesses were. They were over-leveraged, they were undercapitalized, they had no internal risk controls, they were careless with customers' money. In the case of FTX, they used it to line their own pockets. Now the money of millions of Americans is trapped and they might never get it back. Last year, I warned that the splashy Super Bowl ads left out key details. A year ago, I said, as chair of this committee, big crypto companies are looking to make big profits, are desperate to reach as many Americans as they can, hence the $54 million in ads in the Super Bowl. They brought in celebrities and gimmicks to make crypto sound exciting and daring and profitable, immensely profitable. But these ads left a few things out. They didn't mention the fraud, they didn't mention the scams, they didn't mention the outright theft. The ads didn't point out that you can lose big in crypto's huge price swings. They didn't tell you about the high fees pocketed by the crypto companies. And they sure didn't explain that crypto markets lack basic investor protections and oversight. The results were as predictable as they are tragic. Contrary to crypto evangelists' claims of democratizing finance, contrary to crypto evangelists' claims of democratizing finance, it's not the early adopters or the big money investors left holding the bag. When it comes to crypto, it turns out fortune doesn't favor the brave, it favors wealthy insiders. It's not just about a few bad actors that didn't do things quite the right way. These crypto catastrophes have exposed what many of us already knew. Digital assets, cryptocurrencies, stablecoins, investment tokens are speculative products run by reckless companies, we know that's true, that put Americans' hard-earned money at risk. Not surprising from an industry that was created to skirt the rules. Whether it's Facebook Libra or the explosion of crypto, I've always been concerned about shiny new products that really just offer another way to profit off the backs of working Americans and at the same time threatening the real economy. It's time now to consider how to protect consumers from unregulated digital assets and ultimately whom we want our financial system to serve. Last Congress, this committee examined the risks of crypto to our economy, explored the mechanics behind stablecoin companies, looked at how regulators in Congress can protect consumers. We learned how Crypto can be used to commit crimes like drug running and human trafficking, which threaten our national security and help fund terrorists and rogue regimes. We looked at how fraud and speculation in the crypto market hurt investors and savers. Recent crypto meltdowns have made clear we need a comprehensive framework to regulate crypto products to protect consumers and our financial system. Today, we'll examine how time-tested financial safeguards can help protect against the harms and the risks of crypto products. We'll start by taking a closer look at these basic principles of regulation. Clear disclosures and transparency essential so retail customers and investors can understand how a token or crypto platform works. Prohibitions on conflicts of interest and self-dealing by insiders is fundamental. Our markets only work when they work for everyone. Protecting consumer funds by separating them from company assets, investor dollars, can't be a slush fund for the executive's benefit. Internal governance and risk management to make sure if a platform takes customer funds, it acts prudently. Strong consumer and investor rights and protections that are foundation of trust in any financial system and central to a functioning market. Anti-money laundering and fraud prevention to make sure that malign actors and evil nation states can't fund themselves and evade law enforcement. Oversight and supervision to hold companies accountable because access to our financial markets is a privilege, not a right that can be abused. These are basic common sense principles that have developed over centuries of financial system regulation. The wildcat money of the 1800s, the repeated banking panics of the Gilded Age, the 1929 stock market crash, the savings and loan crisis in our lifetime, the dot-com bubble, the great financial crisis. These crises are the story of speculative bubbles fueled by investor euphoria in the promise that this time it's different, even though it really never is. The lessons learned are the product of hard-earned experience born of real people losing real money and of real dreams shattered. Crypto isn't special. We can start with these common sense principles as we consider a regulatory framework for digital assets that puts consumers first and, above all, keeps our financial system safe. I trust this committee, as the ranking member often says, can find common ground and work together to protect investors from crypto risks. Ranking Member Scott.
Thank you, Mr. Chairman. And before I dig into my opening comments, I want to address the elephant in the room. If Chairman Gensler is going to take action, enforcement action, and Congress needs to hear from him very soon. The chairman had lots of time to do the rounds on the morning talk shows. If he has time for that, he should be here testifying with us this morning. And I hope that we see him here very soon. Thank you, Chairman Brown. The free market economy was formed by financial innovation. It's the engine that continues to drive our economy today. But every engine needs fuel, and in order to advance as a country, we must continue to grow and innovate, but we must do so in a safe and sound manner. Innovation can increase access to traditional financial services and may foster new emergent technologies that promote financial independence, access to credit, and capital formation. We all know and understand how technology can improve our daily lives, from using our iPhones or our phones to open bank accounts to opening a digital marketplace. If we foreclose financial innovation, we limit future generations from growth and opportunity. That said, financial innovation must be done so in a safe and sound manner, which unfortunately has not been the case with a number of actors in the digital asset space. For example, for some time, FTX was considered the darling of the crypto industry. Unfortunately, instead of protecting customers' interest and using customer funds in the manner intended, Sam Bankman-Fried, FTX's owner, stole millions of dollars of customers' funds and used them to finance risky bets and to pay for luxury penthouses in the Bahamas. When I consider this massive failure, I wonder whether our regulators, when they were supposedly already had the authority, were they using those authorities? In recent statements, the regulators, the SEC specifically, have noted that it is the responsibility of crypto firms to comply with existing regulations, but it is also the responsibility of regulators to enforce existing regulations and to conduct appropriate, effective supervision. The American people deserve to know why no action was taken prior to FTX's collapse and how millions of dollars of Americans' hard-earned money just vanished into nothing. And it was not just FTX. If the SEC had provided even the slightest bit of guidance, I wonder if we would have been able to protect investors from the collapse of Terra and Luna in May, Celsius in June, Voyager in July, and BlockFi in November. This is particularly alarming when we see the reports that 44% of Americans who own and trade digital assets are new investors or people of color, which means when there is a $2 trillion drop in market cap, our most vulnerable citizens bear the significant brunt. We must hold companies that harm consumers accountable, but we must empower consumers through financial education so that they can more accurately understand the risk posed by different asset classes. Whether it starts in the classroom or in the boardroom, financial literacy provides an avenue for individuals to make better decisions and climb the economic ladder. Nonetheless, regulators have put their misplaced focus on progressive social issues, so we have to ask ourselves, where do we go from here? To date, the SEC has failed to take any meaningful preemptive action to ensure this type of catastrophic failure does not happen again. If they have the tools they need, were they just asleep at the wheel? If they don't, why aren't they here to tell us what they need? We'd be happy to have Chairman Gensler testify sooner, much sooner than later. Moving forward, we must take a thoughtful, bipartisan, and balanced approach that protects consumers and promotes innovation and opportunity. I look forward to hearing our witnesses' perspectives on how we can continue to drive innovation and opportunity while ensuring consumers are protected. Thank you, Chairman.
Thank you, Senator Scott. I'll introduce today's three witnesses. We'll hear from Mr. Lee Reiners, Policy Director at the Duke Financial Economic Center, a lecturing fellow at Duke University School of Law. Welcome, Mr. Reiners. Professor Linda Jeng is the Chief Global Regulatory Officer and General Counsel of the Crypto Council for Innovation. She's also the visiting scholar in financial technology, adjunct professor of law at Georgetown University Law Center's Institute for International Economic Law, and a senior lecturing fellow also at Duke Law School. Professor Yadav is the Milton Underwood Chair, Professor of Law, Associate Dean at Vanderbilt Law School. Professor Yadav, welcome you. Mr. Reiners, if you'd begin.
Chairman Brown, Ranking Member Scott, and members of the committee, thank you for inviting me to testify at today's hearing. My name is Lee Reiners, and I'm the Policy Director at the Duke Financial Economic Center and a lecturing fellow at Duke University School of Law. At Duke, I teach courses in cryptocurrency law and financial regulation. And prior to entering academia, I spent 5 years examining systemically important financial institutions at the Federal Reserve Bank of New York. Satoshi Nakamoto introduced the first cryptocurrency, Bitcoin, to the world in a 9-page white paper posted on Halloween 2008. And the first Bitcoin transaction occurred in January 2009. 14 years, thousands of cryptocurrencies, and trillions of investor losses later, crypto scarcely resembles the purely peer-to-peer version of electronic cash first envisioned by Satoshi. By technology standards, crypto is not new. For comparison, the iPhone was introduced in 2007. Anyone who held a smartphone in their hand for the first time immediately recognized its transformative potential. More recently, OpenAI made the artificial intelligence chatbot, ChatGPT, available to the public last November. 2 months later, ChatGPT had 100 million monthly active users, making it the fastest growing consumer application in history. After 14 years and countless claims that crypto represents the future of money, finance, or something else, we have yet to see crypto's killer use case. In fact, only 16% of US adults have invested in, traded, or used crypto. The data is clear. Most people invested in crypto simply because they thought they could sell it to someone else at a higher price in the future. Sadly, these people were wrong. 14 years have provided ample evidence of the dire harm cryptocurrency inflicts throughout our society. Beyond the billions in investor losses due to frauds, hacks, and scams, crypto undermines our national security by facilitating terrorist financing and sanctions evasion. It undermines our economic security by fueling a surge in ransomware attacks that have crippled American businesses, healthcare systems, and municipal governments. And it jeopardizes our climate goals by needlessly consuming massive amounts of energy that contribute to carbon emissions and electronic waste. I ask, What benefits do we have to show for these costs? Even as we stand in the ashes of the FTX implosion, the crypto industry is spinning new narratives to deflect and obfuscate the damage they have wrought. One such line goes that Sam Bankman-Fried was just a bad apple, and that the problem lies not with crypto's underlying technology, but with centralized crypto intermediaries. But FTX was not an isolated incident. Terra Luna, Celsius, Voyager, BlockFi, Axie Infinity, Genesis, Mango Markets. How many more must fail before we conclude that the entire barrel is rotten? Another self-serving line spun by crypto boosters is that policymakers must embrace innovation, or else the crypto industry will migrate to other jurisdictions with a more favorable regulatory climate. But this implies that innovation is an unmitigated good. The truth is that innovation is value neutral. It can be used for good or bad. Instagram for kids is technically innovative, but does anyone think it's a good idea? Looking at crypto, it is clear that the costs outweigh the benefits. So why would we want to embrace it? The millions of Americans who invested in crypto only to see their hard-earned money evaporate do not care whether crypto is classified as a commodity or a security. They do not care whether the industry is regulated by the SEC, CFTC, or some other agency. They only care about having the same basic safeguards they have come to know and expect from the traditional financial system. Unfortunately, we have let them down. The time has come for action, action that only Congress can provide. While I agree with SEC Chairman Gary Gensler that most cryptocurrencies are securities subject to SEC registration and disclosure requirements, some cryptocurrencies, like Bitcoin, are commodities. While the CFTC regulates commodity derivatives, they do not regulate commodity spot markets. The practical effect of this structure is that cryptocurrency exchanges in the US are presently not regulated at the federal level. In my written testimony, I provide a detailed roadmap for how Congress can close this gap. I urge Congress to carve out cryptocurrency from the definition of commodity in the Commodity Exchange Act and recognize cryptocurrencies as securities under a special definition to the securities laws. This would give the SEC exclusive authority to regulate all aspects of the crypto industry. The SEC simply has more expertise, more resources, and more appetite for enforcement in the crypto realm than the CFTC does. Most importantly, unlike the CFTC, the SEC has a statutory mandate to protect investors. Whatever Congress decides to do, the status quo is simply untenable. I look forward to discussing the way forward with you. Thank you.
Thank you, Professor Reiners. Professor Jeng, welcome.
Chairman Brown, Ranking Member Scott, and members of the committee, it is a pleasure to be here with you today. Thank you for the opportunity to testify. The Banking Committee was where I cut my teeth on financial policy, working on the response to the global financial crisis. I've been impressed by and am thankful for the bipartisanship this committee has long embraced. Today's hearing is yet another example of its leadership. With inflationary pressures not seen since the 1970s, market volatility, and changes to the Fed's longstanding monetary policies, I've been asked to discuss how best to strategically think about the regulatory future of our digital economy. As a former regulator myself, I am particularly concerned about this area of our shared digital future and how we can all ensure the best outcomes for American consumers while promoting innovation. In this light, I am testifying in my personal capacity as an academic and researcher. I am a visiting scholar on financial technology and adjunct professor at the Institute of International Economic Law at Georgetown, and a senior lecturing fellow at Duke Law. In addition, I am the Chief Global Regulatory Officer of the Crypto Council for Innovation, a global industry alliance of companies operating in the digital assets ecosystem. Technological innovation enhances people's lives in meaningful ways. As someone who has spent years working on financial regulation in a number of roles, I know that in the financial sector, policy should focus on a number of key areas: empowering consumers, ensuring open markets, increasing efficiency, and lowering costs for consumers. In short, technological innovation should be harnessed to improve access, efficiency, and equity for digital consumers. To facilitate the growth of a resilient and sustainable digital future, policymakers should be intentional in their choice of building blocks. In my experience, these blocks must address a range of issues, including consumer and investor protection, digital money, digital identity, decentralized finance, private commercial law, bankruptcy, accounting, tax, technology standards, energy, illicit finance, and national security. The development of a flourishing digital ecosystem ultimately relies upon innovators, as well as laws, regulations, and policies that guide policymakers, investors, and businesses to facilitate long-term value. Currently, companies operating in the digital asset space in the US are subject to a patchwork of state and federal regulatory requirements. For example, crypto exchanges typically must secure a state money transmission license or obtain a license through a tailored regime such as the New York Department of Financial Services BitLicense. And importantly, at the federal level, companies are required to register as money service businesses with the US Treasury's FinCEN and comply with AML-CFT rules. But the absence of a transparent and consistent federal regulatory framework, coupled with successful state regulatory regimes, causes uncertainty for businesses and innovators while often failing to protect consumers and investors. In the past year, we have seen legitimate projects fail and outright fraud committed against customers transacting in digital assets. Both have caused significant harm. These losses underscore the urgent need to establish formal federal regulatory oversight and demonstrate the inadequacy of regulating solely by enforcement. To date, and for the purposes of this committee's jurisdiction, the SEC has not initiated any formal rulemaking process to update securities laws that are decades old to account for the unique attributes of digital assets that are determined to be securities. Given this unusual departure from the normal and well-established process of public rulemaking, Congress urgently needs to pass thoughtful, comprehensive legislation that establishes a federal regulatory framework for digital assets, addressing both securities and non-securities. In this complex and nuanced space, the details matter. Failure to enact rules, even through rulemaking or legislation that protect investors and allow digital assets to develop in the US, would risk offshoring innovation and putting American businesses, consumers, and the economy at a competitive disadvantage with our foreign peers. It could also jeopardize an important national security lever of the US government, the preeminence of our financial system. Thank you again for the opportunity to testify today. I look forward to answering your questions.
Thank you, Professor Jeng. Professor Yadav, welcome.
Chairman Brown, Ranking Member Scott, distinguished members of this committee. Thank you so very much for the opportunity to be here today. It's an extraordinary honor and a privilege for me. I hope that my testimony today can be of some help to this committee as you progress your review into thinking about the causes of this crypto crash and the steps that we need to take to shore up this financial system, as well as, most importantly, to protect those who use it. Now, we've been asked today to consider why financial system safeguards are needed for the cryptocurrency market. And I think the evidence is becoming clear for all of us to see. The digital asset markets today is big, it's becoming popular, it's sophisticated, and it's becoming increasingly financialized. And the cost of being late to regulation is becoming obvious to all of us. Now, as we've seen in the case of FTX, for example, a case that I imagine we'll talk about extensively during this hearing, the bankruptcy court in Delaware is having to deal with the consequences. We are talking about approximately 9 million estimated creditors, 134 entities, everyday customers, both retail as well as institutional, that are now clamoring to get their money outside of the bankruptcy system. At the same time, these legal processes are extremely expensive. They're long, and the outcomes are extremely unclear. But what is becoming straightforward here is that these customers are likely to become unsecured creditors of the estate and very likely to be last in line to be paid out when the recoveries do come. Now, senators, this entire episode obviously casts enormous doubt, reduces trust and confidence, of course, in the cryptocurrency exchanges as well as the cryptocurrency industry. But senators, it also casts a lot of doubt on the trust and confidence of the regulatory system. It is unfortunate that expert technical determinations about very important matters, such as how assets in cryptocurrency, for cryptocurrency assets should be custodied, how those custody arrangements should work, are now getting to be taken, not by our extremely expert, our extremely talented regulatory agencies, but instead by the bankruptcy court. Now, the bankruptcy court is, of course, extremely talented and extremely expert, but it's an expert in distributing scarce assets across hurt and distressed creditors. Now, Senators, what I would like to propose to you today is to create a solution that can help to get a regulatory framework up and running quickly, one that is useful for and able to integrate quickly into the larger comprehensive and federal oversight system that we have today. What I'm proposing is the creation of a self-regulatory regime where cryptocurrency exchanges are tasked with oversight of the market as a whole. This would bring cryptocurrency exchanges in line with traditional commodities and securities exchanges, where self-regulation by exchanges has been the norm essentially for centuries. What this proposal would do would essentially task cryptocurrency exchanges with writing rules, with monitoring the market, and with exercising discipline. But really the goal of this proposal, Senator, is threefold. Firstly, it seeks to bring cryptocurrency exchanges within a framework for federal oversight. Our agencies would be tasked with vetting and carefully overseeing these exchanges to make sure that they're doing their job. They would have to make sure that these exchanges have the organizational capacity that they need to do their job. Second of all, it would seek to make cryptocurrency exchanges accountable. What that would mean is that if they fall in their ability to do oversight, then they would have to pay. They would have to pay financial penalties. In addition, of course, they would suffer loss of reputational damages. Now, third of all, it would make sure that cryptocurrency exchanges are in fact paying to look after their market. This means using their resources, using their expertise, using their knowledge, using their proximity to the technology to make their marketplace, as well as themselves, much more honest, much more stable, and much more driven towards protecting customers. Now, Senators, to be very, very clear with you, this is not in any way a substitute for public regulation. Rather, it's designed to be a complement. This is a solution that's supposed to integrate seamlessly into a larger federal oversight framework, and it's one that we have seen working in the traditional market for a very long time indeed. Senators, this is also not a proposal that is without its faults. There's certainly enormous faults to be had in this market. Now, certainly in the traditional marketplace, we have seen exchange oversight by exchanges suffer from various conflicts of interest. So this is really a proposal, Senators, which is designed to get a market up and running quickly. It seeks to make agencies respond. It seeks to make the exchanges responsible. It seeks to make the exchanges accountable. And it seeks to force these exchanges, which are anchor pieces, central parts of this entire ecosystem, responsible much more formally for bringing safety, stability, and consumer protection to the heart of the cryptocurrency market. Senators, the adage goes that we should not let the crisis go to waste, and I would urge you to not let that happen here, so that we're not left wondering how we could prevent another FTX from happening. Thank you so very much, and I look forward to your questions.
Thank you, Professor Yadav. Professor Reiners, start with you. Some in the crypto industry have complained about recent SEC enforcement actions against crypto firms for offering unregistered investment products. Some of these companies entice consumers to put their crypto to work to earn double-digit returns. Shouldn't a financial product that takes in billions of dollars in retail consumer money operate with basic consumer protections?
Yes, it should, Senator. And I would point out that the crypto industry is very fond of criticizing the SEC for regulation by enforcement. But the truth is that it's just a catchphrase that the industry uses to deflect from the fact that they've willingly chosen to operate outside the regulatory perimeter. And the SEC has been quite clear, going back to the chairmanship of Jay Clayton. Most cryptocurrencies are securities that need to be registered with the Commission. And the SEC has filed over 125 enforcement actions, and they haven't lost a single case related to cryptocurrency. So the judges think it's quite clear as well. The only people who seem to be confused about this is the crypto industry.
Thank you. Professor Yadav, your testimony discussed how stock exchanges are regulated, how to extend similar safeguards to crypto exchanges. What are the established safeguards that can benefit consumers, that can increase market transparency and prohibit conflicts?
So, Senator, thank you so much for that question. Stock exchanges have been providing self-regulation of this market for a long time. And I think it's important to consider the counterfactual here, which is that these extremely powerful, extremely central, extremely important parts of the institution, what would happen if they weren't required to do so? And what we have here is essentially a marketplace in which we are using the private self-interest of these exchanges to provide a public good. Now, in the context of the exchanges themselves, what they do provide is having having expertise within the marketplace to surveil trading from a very proximate standpoint. They are responsible for enforcing under Section 6 of the Securities and Exchange Act standards of preventing fraud, manipulation, and to create a fair and equitable marketplace. Now, certainly this oversight is not perfect, Senator, but at the same time, it's better than what we would have if we didn't have it. And so in this context, there've been various steps taken in the context of preventing these conflicts of interest. So, for example, entity separations within these exchanges. FINRA is another organization that is there to prevent potential conflicts from occurring. And so overall, this is a system that provides a complement to public oversight rather than necessarily being any kind of substitute for it.
Thank you. Mr. Reiners, again, the collapse of FTX has focused attention on basic protections like safeguarding customer money so companies can't use it for their own personal benefit. Explain briefly the urgency to us, the urgency to develop better standards for the custody of consumer assets.
Yes, Senator. So unfortunately, millions of Americans have found out that if they've used a crypto exchange and that exchange has failed, they are now unsecured creditors in that bankruptcy estate. So they do not have control or access to those assets. Of course, that's very different than the situation we have with banks, which are FDIC insured, or with traditional broker-dealers, which are subject to SIPC insurance. So if there's going to be one change that I would recommend Congress focus on, it'd be requiring these crypto platforms to segregate customer assets from firm assets so that if these firms do get into trouble, customers will still have access to their funds.
Thank you. Last question I would ask all three of you to answer. There are many ways to protect consumers in the crypto market. One thing is clear, that customers deserve to understand better the investment they're making. My question for the panel, without debating the ways cryptocurrencies are different from stocks or bonds, is it reasonable to start the conversation with the investment disclosures that we're familiar with? So, Professor Yadav, start with you. Let's go down the line. Each of you briefly explain how we can use existing disclosure principles for crypto.
Senator, I'm so glad you asked that question. This is an essential part of the process, which is to have disclosures reveal insight about what exactly the governance is of the issuers that are providing this technology, in addition about the blockchains, as well as obviously the underlying technologies that are animating these offerings. Now, what we have here today is a disclosure system that needs to work. As Ranking Member Scott discussed earlier, this is a technology that has been popularized and is being used by increasingly younger people, folks in minority communities, and so it's extremely important not just to focus on disclosure, but also literacy, making sure that these disclosures work. I have a terrific co-author that has done work on making sure that disclosures are readable, making sure that disclosures are usable, encouraging people in different ways to engage with the actual information they're seeing. Otherwise, just having a thick bundle of information does no good whatsoever if it's not something that is able to communicate these risks and opportunities effectively.
Thank you. Professor Jeng.
This is a very important question. One of the very interesting issues about this is that it is transparent in code, right? But as a former regulator who worked with blockchain engineers, and I do not code, I need the engineers to actually explain to me how the product was actually designed. So white papers that clearly explain how it's designed, what the risks are, who holds the private keys, the governance, the voting rights, and then more importantly, where are the funds held? These are the important issues that need to be included in the disclosures.
Thank you, Mr. Reiners.
Senator, we've had a basic bargain in our capital market since the 1930s, and that is that companies that want to raise money from the public have to disclose the risk involved in that. And then investors are free to choose what risks they want to take. And so I see no reason why that principle shouldn't apply to crypto, although I'll agree with Professor Yadav's point that maybe the specifics of what gets disclosed can be debated, and I think the SEC does have the authority, and I think Congress should give them the authority to draft customized disclosure regimes for certain decentralized crypto products, and the EU is moving in that direction, but disclosure is necessary.
Thank you. I guess the $54 million of Super Bowl ads a year ago and 0 ads this year sort of underscore that. Ranking Member Scott.
Thank you, Mr. Chairman. Just to finish Professor Yadav's point on disclosures. Having sold mutual funds in a past life, I will say that having a prospectus that the average person can understand would be really helpful. The truth of the matter is, disclosure sounds great until you try to read a prospectus and you can't figure out what in the world it says. So I think plain English would be very helpful for the vast majority of our folks who are first-time investors to understand what it is that they're investing in. And I would say without any question, this is an area where that is really important because of the complexity of the actual underlying asset itself. Right now, the United States has the strongest and most enviable capital markets in the world. The reason for this is a very simple reason. The sun never sets on American innovation. Over decades, we have fostered a financial environment that has decreased poverty, increased homeownership, and made the American dream a reality for more and more of our citizens. Our goal should not be any different when it comes to digital assets. Our aim should be to provide rules of the road that are clear, consistent, and most importantly, foster an environment that rewards opportunity while ensuring consumers are informed and protected against fraud and deception. As we speak here, several countries across the globe are creating their own framework to address the rise of cryptocurrency. Unfortunately, our regulators have muddied the waters. We have been told everything from we need legislation to more recently that regulators have the tools they need to supervise this industry. That is quite a flip-flop. Once again, it is really important that we have Chair Gensler here before September. It is far too far in the future for us to wait that long before we hear from Chairman Gensler. The regulators have permitted activity in this space without providing clear rules of the road, which has unfortunately led to the multiple failures that brings us here today. Let's be clear. Had the SEC provided anything besides hostility to the crypto industry, we may have been able to save investors from losing billions of dollars on FTX, Celsius, BlockFi, and the list goes on. So my question, Professor Jeng, what should Congress keep in mind when it considers developing an approach to the crypto industry? How do we strike a balance between appropriate and thoughtful regulation and the tool of innovation that it could be?
Thank you, Senator, for that very important question. We are at a pivotal moment in history where the decisions that you all make as policymakers will affect how our economy grows in the future. And currently, we are becoming a data-driven digital economy. What does that mean? That means that our activities are increasingly based upon data and on blockchain technologies. So the kind of guardrails that you put in place now will affect generations to come. Many of the issues that you need to think about will include certainly consumer protection, but also consumer rights and consumer empowerment. Currently, there are countries around the world who are also looking at how to take advantage of crypto technologies, China being a good example. But in that situation, it's the government that wants to actually control the personal data. Here is an opportunity for you all to create the framework for consumer empowerment, for consumer data rights that serves as a foundation for a digital economy.
As I noted in my opening statement, innovation can be a positive driver in expanding access to traditional financial services and can foster new additional technologies that promote financial independence, access to credit, and capital formation. It is astounding what financial innovation can do for people when they are given the ability to make their own choices and allowed the flexibility to innovate. While we've talked about cryptocurrency a lot, innovation in the technology space is not limited to crypto. FinTech is another classic example of things that are moving in a positive direction. Question for the whole panel. Can you speak to the benefits you see for everyday Americans in the digital asset space and the need to ensure that regulation does not stifle innovation? Professor?
Great. Thank you so much, Senator Scott, for that question. Innovation here is something that is moving extremely fast in terms of trying to improve the efficiency, for example, of the payment system. Now, one thing that is very clear in the US is that despite us having a state-of-the-art financial system, our payment system is lagging behind. And what we have seen, for example, in the context of fintech, is the ability to try and make payments much more usable. For example, using smartphone technology, for example, trying to have contactless payments. The world that we inhabited 10 years ago in terms of payments is not the world that we inhabit today, and yet there are still some problems. For example, if these are things that you've heard in this committee before. It takes time, days in fact, for payments to settle. Checks take days in order to move. In addition, obviously, there are enormous costs involved with this. Now, this obviously leaves out folks that don't necessarily have a bank account and don't have access to the full panoply of financial services. So the question is, how do we make innovation work for people so that we're able to bring everyone into the fold in a much more inclusive and cheap and efficient way? Now, certainly some of the technologies that are being proposed, even in digital assets, are trying to do that. And so certainly that is something, a potential use case that could be worth exploring, provided that it is, substantively and properly regulated.
Thank you. Professor Jeng?
Thanks, Senator Scott.
Let me hear from the professor real quick.
I'm sorry, I think you okay.
Thank you for the opportunity. So one of the very important issues to take into account is consumer rights and property rights. We need a clear set of rules. And what do I mean by that? My husband's from Ireland. When I'm in Ireland, I have to drive on the left side of the road. If I'm not told that, I would get into a car crash. Similarly here, we, as a professor looking at the system, there is an urgent need for a regulatory framework that clearly states what are the consumer rights and also what are responsibilities of crypto participants.
Thank you, Ranking Member Scott. Senator Menendez from New Jersey is recognized.
Mr. Chairman. Last fall, the Financial Stability Oversight Council released its 2022 report on digital asset financial stability risks and regulations. And one of FSOC's recommendations was that Congress pass legislation providing rule-making authority to financial regulators over the spot market for non-security digital assets. Mr. Reiners, why is it important that Congress address this gap? And how would you propose that we do it?
So, Senator Menendez, for the past 10 years or so, the big debate when it comes to crypto regulation is, are these things commodities or securities? And of course, the Howey test is principally what's used to determine whether or not a given token is an investment contract and therefore a security. Now, I happen to agree with Chair Gensler that most cryptocurrencies are securities, that they meet the Howey test. But there are some cryptocurrencies, and I'll just use Bitcoin as an example, that are decentralized enough that they are commodities. And the CFTC regulates commodity spot markets, but they don't regulate commodity spot markets. They only regulate commodity derivatives markets, although they do have fraud and manipulation enforcement authority in commodity spot markets. So that is the gap that needs to be addressed. And so what I recommend, and I have this detailed in my written testimony, is that Congress carve out the cryptocurrency from the definition of commodity in the Commodity Exchange Act and include cryptocurrency as a new category of security under securities law, so that's clear to everyone, to the market and everyone else, that the SEC has exclusive rulemaking authority and jurisdiction over cryptocurrency.
Professor Jeng and Professor Yadav, any views on this?
Thank you so much, Senator Menendez. I think one of the main things that we have to figure out how to do, at least in my proposal, is to make the private industry accountable and to make the private industry responsible. So as set out in my written testimony, some of the major, arguably the most important institutions in this economy are the exchanges. And we have to find a way to make them play their part in making sure that this market becomes a safer and much more consumerly protective market. Now, in this context, what I propose is to create this framework for exchanges to become self-regulatory organizations very clearly under a framework of oversight that could be administered by agencies jointly. I think this is a gap here. In other words, that we're allowing exchanges to become very big. We're allowing them to become sophisticated. We're allowing them to inhabit governance structures that are extremely centralized and subject to conflicts of interest, and we need to bring that under control because exchanges are providing on-ramps into the cryptocurrency market for really the vast swath of the population.
There are many different types of digital assets, some of which are like Bitcoin, native cryptocurrencies. Others are like fiat-backed stablecoins, which will act as digital money. And so, for example, if I give you a green paper dollar bill, you know when you take it from me that nobody has an interest or title to that dollar bill. That's why it acts so well as a medium of exchange. To ensure that we will have a digital economy that can run on digital money, we need to make sure that fiat-backed stablecoins and other types of digital money, that could include CBDC as well, are also going to be free of interest or title. And hence why putting it under the SEC framework was problematic, because again, you know, I cannot pay you with a security.
Well, we're trying to figure this out. The key element I'll be looking for in digital asset legislation is a clear prioritization of transparency and investor protection, which is also providing for stability and while also providing for stability and safe innovation. These are values that make our current financial system strong and effective, and should equally apply to, I believe, to the digital assets. Let me just ask you, Professors Jeng and Yadav, for decades, the United States has been a leader in the global financial system, which has had an immeasurable asset to American consumers, and in my role as the chairman of the Foreign Relations Committee, our foreign policy goals as well. We should look to continue that leadership as we work to develop digital assets regulations. Can each of you talk about some of the global trends we're seeing on crypto regulation? Is the U.S. ahead or behind the curve?
Senator Menendez, unfortunately, the U.S. is extremely behind the curve at this point. One thing that we have done, as you mentioned, extraordinarily well over the last 10 years is have leadership in standard setting. We have been incredibly powerful exporters of our financial markets regulation abroad. And this is so important because it means that other countries have adopted key principles that we use in our markets to make our markets work and make our markets safe. One example here would be the leverage ratio, for example, that we use in our banking system that has now become an export that is being used more broadly abroad. In the case of digital asset regulation, unfortunately, however, we really do not have anything to export at present. Unfortunately, other countries have taken a lead, and in particular, the EU here has set out a very comprehensive framework in the form of the market in the market in crypto assets regulation. Now, this is likely to come in force in April, perhaps later this, April or later this year. And this is a very comprehensive framework that has set the stage for the U.S. essentially to become a potential second there in terms of coming up with a plan for an agenda for digital asset regulation. So here, it doesn't feel like we're leading. It feels like we're potentially following others where they have taken a lead and have set the standards and are using their frameworks to say what rules are good and what rules are bad.
To add to Professor Yesha's remarks, it's not just that other countries are adopting regulations. Other countries are pursuing very thoughtful national digital strategies. And you look at the EU, which has in place not just MiCA, but GDPR and other regulations like the Digital Markets Act. It is all part of a comprehensive strategy that they are pursuing. UK is in the process of consulting its proposal on regulating crypto assets. Australia has been pursuing a long-term national data strategy and has just came out with its proposal on taxonomies of crypto assets. Hong Kong is about to come out with a consultation. Singapore just finished its consultation in December. As you can see, the list just goes on, and not to mention China, which has been pursuing a multi-year crypto strategy.
Senator Menendez.
Thanks, Senator Menendez. Oh, I'm sorry, you and Mr. Reiners too. Okay.
So I don't think the U.S. is falling behind. I think the important thing is that we get regulation right, not that we necessarily be the first. And in many of those other jurisdictions that Professor Jeng was mentioning, they're embracing crypto because essentially they're gambling that it can help juice their economy. But look at the situation in the Bahamas, where they embraced crypto. They rolled out the red carpet for Sam Bankman-Fried, and obviously it didn't turn out so well. So as I said in my opening testimony, crypto is doing more harm than good to our society. As you mentioned, it's undermining U.S. national security by facilitating sanctions evasion, terrorist financing. The dollar and New York's status for dollar clearing is an instrument of foreign policy, and crypto undermines all of that. So we should not be embracing something that is undermining our sovereignty. And so I think the important thing is getting financial regulation right in this space with what I call a dual mandate, one, protecting investors, and two, preserving financial stability. And that is an upside to the most recent crypto winners, that it hasn't spilled into the traditional financial system. And it's largely due to the actions of the SEC and the federal banking agencies, who have had clear rules in place for the better part of a year that basically say if you are a regulated bank and want to engage in crypto activity, you need to get permission from us first. And that really prevented a lot of banks from engaging more heavily in crypto activity. And this story would be very different if we had banks engaged in crypto activity.
Thank you. Senator Vance of Ohio is recognized.
Thank you, Mr. Chairman, and thanks to the witnesses here. I'm going to pose this first question to all three of you, but maybe give you some background on where I'm coming from. So, I'm probably one of the few members of the committee that actually owns cryptocurrency. I've been fascinated by it for a long time. But I also, recognize that there are downsides to it, that there are risks that come along with it. And my basic bias here is that we don't really know what it is yet, meaning not just cryptocurrency, but a lot of the other underlying and related Web3 technologies, and that our regulatory approach should basically be to protect consumers while ensuring that we don't destroy the dynamic upside of this. And here's what I mean by the dynamic upside. Mr. Is it Reiners? What you just said is fascinating to me, and that I can tell you're sort of skeptical of the role that crypto is playing in society right now. And look, after what happened with Sam Bankman-Fried, there's a lot of cause for skepticism. What I wonder is how people would have described the internet in the 1970s, the 1980s, before it was commercially available, before it was a major part of the way that we did commerce. And that if we had taken an overbearing approach then, we might have destroyed a lot of the upside that have come over the last 3 decades. So I'm going to put this question to each of you, maybe just going from left to right. How do you think about that, about regulating crypto, not just in a way that protects consumers and also protects the upsides of the technology right now in February of 2023, but ensures that the innovation that's going to happen on this platform, which is really how I think of it, actually happens in a way that's relatively free, relatively fair, and preserves, as Senator Menendez said, the fact that this could become a tool in America's foreign policy and economic arsenal?
Yeah, thank you for that question, Senator. So I'll respond by saying that crypto is not new. The first Bitcoin transaction was in 2009. So we have a 14-year track record to look back and assess this. And it didn't take the internet 14 years to prove its worth. And so when you look at cryptocurrencies, I would just ask, what's the fundamental value? Why are they worth anything? Normal financial assets are someone else's liability, right? There's an issuer. Otherwise, where would the returns come from? So there's no reason to think that cryptocurrency is going to generate returns indefinitely into the future. It's clear that people are just buying it because they think they can sell it to someone else at a higher price in the future. There's no fundamentals. Now, that doesn't mean necessarily that blockchain doesn't have value, and I think there's a way to regulate the risk associated with crypto and to the consumer protections point that you raise, while still allowing traditional financial services to experiment with blockchain as they are. And I think our existing financial regulatory framework is more than capable of keeping up with the traditional financial system using blockchain. But unbacked crypto assets, there's no there, and we have plenty of history to prove it.
Professor Jeng.
Thank you, Senator. I like very much your analogy to the internet. I was just speaking with a colleague of mine at Wharton who had began his legal career at the FCC, and he told me at that time, and I'm dating his age very clearly, but he said one of the big fights at the FCC was whether to license internet charters. I don't even know what that means, the question was, should internet providers have to register with the FCC? Should page providers, site providers, et cetera? And if they had decided yes, I think the internet would be very different today, and we may not even have blockchain technologies. So why am I bringing this up? It's extremely important that we have open, interoperable standards. And that is the spirit of blockchain technology. The idea is that these technologies produce stacks that are composable, almost like Legos. And so with the iPhone, you can then build apps on top, GPS locators, and then be able to use Uber on top of that, and then maybe your finances. why we need to think in terms of pushing for open, interoperable standards is to prevent monopolies of the future. So digital identity is going to be the cornerstone of the digital economy. And right now, there are some companies, and I'm not going to name them right now, but they are digitizing our driver's licenses in closed wallet solutions. And that means these companies, and you can probably guess who they are going to have an advantage over who are using their wallets whenever they are trying to transact and are required to share their personal data, including their driver's license. And so down the road, you'll end up with digital transactions that are viewable only by these companies, and other companies are not allowed to actually build on top of the digital identity. So we have to actually set the guardrails in the right balance to allow for innovation, but not have companies or bad players take advantage of that openness.
Great. Mr. Yadav.
Thank you so much, Senator, for that question. We've had innovation for as long as we can remember in this economy. So, for example, from the ATM to all the financial engineering that we saw pre-crisis, we've had a ton of innovation that is, constantly and consistently a part of the American financial system. The way in which we've tackled it is by having a dialogue amongst regulators to approach this in a smart way that includes, obviously, contributions from the industry. Now, certainly, as Professor Reiners mentioned, Bitcoin has been there for 14 years, but what we have seen in the crypto economy, for example, is a real uptick in activity, particularly in the last 3 years. So, for example, DeFi transactions have increased almost 900% in 2021. We've seen extraordinary transaction volumes on crypto exchanges, almost 689% gains from 2020 to 2021. So we've seen more people coming into this economy to sort of try out new products and so forth. Now, that has obviously created risks, and it means that we need to understand them. It means that we need to use the tried and tested rules, the tools that we had to understand and regulate innovation, to think about innovation, and to encourage innovation through, for example, tools like disclosure, as was discussed earlier, in addition to making sure that the entities that are engaging in innovation are doing so safely, for example, keeping minimum capital buffers, for example, making sure that those people who are providing products and taking money from other people are doing so in a way that has proper internal controls. These are things that we have used before, we've tried before, there's encouraged innovation before. I think the need for this now is urgent, given the expansion and sophistication of the crypto framework, and I think we can continue to balance the need for market integrity and consumer protection, as well as making sure that we can do innovation, but provided we can get regulators on board, as well as have industry contribute to that dialogue in a systematic way.
Great. Thank you.
Thank you.
Thanks, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman, and thank all of you for your testimony here today. Mr. Reiners, in your testimony, you argue that bank regulators should learn from previous incidents where crypto failures impacted the banks that they worked with. And I agree. Earlier, back in December in this committee, we heard from Professor Hillary Allen, and she made a case for a Glass-Steagall 2.0 model, separating banking entirely from crypto asset activities. In your testimony, you indicate that that's probably beyond the agency's authority to do, even if they wanted to do it, and you urge that we look at other alternatives to develop a comprehensive framework that clarifies, and I'm quoting from your testimony here now, a comprehensive framework that clarifies the type of crypto asset activities banks can engage in and the prudential requirements, capital and liquidity required to engage in such activity. Could you expand on that and provide a little more detail as to what you're thinking?
Yeah, thank you, Senator. And I'm a friend and admirer of Professor Allen's work, and I certainly agree with the sentiment that we should do everything we can to restrict crypto from entering the banking system. But as long as crypto's legal, then these firms are entitled to banking services. So I think the challenge is, where do you draw the line? What specific crypto activity can be done in a safe and sound manner? And so I think the banking agencies have started off on the right foot and having guidance in place that says if you're a regulated bank, so this is the FDIC, OCC, and Fed, all have guidance in place that says if you're a regulated bank and you want to engage in crypto activity, you have to let us know first. But again, I think more is needed. And so what I recommend is that banking agencies do a horizontal exercise where they understand all the different ways that banks are exposed to crypto, and then release that information to the public so that not only bank customers, but bank investors as well are aware of the risk. Because the guidance hasn't been perfect, and we've seen a few banks that, unbeknownst to regulators, were more exposed to crypto than previously realized. And I would just point Silvergate as a perfect example. Over 90% of their deposits were from crypto-related firms. In the fourth quarter of last year, they saw over $8 billion in deposits leave. That was over 60% of their deposit base. And it looks likely that they would have failed if they did not get emergency liquidity from the Federal Home Loan Bank of San Francisco, which of course is not the reason that we have federal home loan banks. They exist to support home ownership, not to bail out banks that gamble on crypto. Again, I think the challenge is, where do you draw the line? The Basel Committee finalized their guidance in December. The U.S. has a history, of course, of gold plating, as they say, Basel standards, and I think that's certainly warranted in this case as well, because if crypto had been more integrated in the banking system, the fallout of FTX would have been much, much worse.
Right. No, I think that's a really important point. And I guess to just ask you to expand a little bit more on this, do you think our banking regulators are taking all the steps that they are authorized to do under current law to try to prevent crypto from sort of making its way into the banking system in a way that puts consumers at risk? Is there any additional measures that they should be taking? And if they've exhausted their authorities, do you support legislation along the lines of that Professor Allen suggested?
So banking agencies have broad legal authority to prohibit banks from engaging in any activity that can't be conducted in a safe and sound manner. So I do think that they can do more and be more prescriptive around what specific crypto-related activities can and cannot be done in a safe and sound manner. For instance, there is absolutely no reason why banks should hold cryptocurrency as a principal on their balance sheet. Now, the joint statement that the banking agencies released at the beginning of January alludes to the fact that the agencies would look very askance at banks that wanted to do that. But I think certainly clear guidance that just says you can't do this is warranted.
Got it. Thank you. Thank you, Mr. Chairman.
Thank you, Senator Allen. Senator Brett is recognized from Alabama. Welcome.
Thank you, Mr. Chairman. So countless Americans confidentially participate in our financial system and markets every day. They're informed of the risk associated with the decisions they make, and they choose what they want to pursue. For example, whether it's stocks or bonds, or whether we're talking about mutual funds or traditional savings accounts. However, what we've seen now is that our current laws and regulations do not speak to the recent innovations within our financial sector. And in fact, Congress has a responsibility to act, to establish rules of the road to ensure robust transparency and protection for consumers and investors. However, we have seen this past year alone show the consequences of what happens when Congress fails to do that. My question is for Ms. Jeng. Just like the rest of the financial sector, we must ensure that appropriate common sense guardrails are in place so consumers have transparency in the digital asset space. I've heard you talk about these common sense guardrails. You've mentioned protecting consumers, their rights, and empowering them. Can you tell me from your perspective what Congress needs to keep in mind while developing these types of guardrails?
Thank you, Senator, for this opportunity to expound upon what I think are key foundational building blocks that Congress needs to consider. Consumer and investor protection, that is crucial, and having clear legal rights in the property that they purchase. When part of the problem with the bankruptcies is that the bankruptcy court had really nothing to work with in terms of legal rights. And so here's an opportunity for Congress to make very clear that when consumers purchase digital assets, that they have a property right in that digital asset, and then that will be respected in a bankruptcy proceeding. The other really important concern to keep in mind is that this kind of technology is about democratizing financial services, and that means when I, for example, moved back to the US from Europe, I had to pay $4,000 to my European bank to move my own savings back to the US. And then I also had no profit from the spread the bank made when it converted from Swiss francs to US dollars. This is the type of opportunity that blockchain technology can help with. I look forward to that day when I'll be able to transfer money cross-border to myself and actually also make part of that profit in the spread. And that kind of equitable interest in financial services is what makes Web3 different from, say, Web2. And so we have to think about how can we empower consumers, give them consumer data rights, while also protecting them through disclosures and legal protections in bankruptcy.
Well, staying on that same line of thought of empowering consumers, I was struck in your testimony here about who the actual purchasers of digital assets are. You have here 55% do not have a college degree, 44% of crypto traders are not white, 41% of traders are women. And knowing that, do you believe that if we put in proper guidelines and guardrails, that there's an opportunity for more people across this nation to achieve the American dream through the use of digital assets?
Currently in the US, 4% are unbanked, 14% are underbanked. I think that's a huge amount for a country as rich and advanced as ours. They feel that they are excluded from the traditional financial system. Here's an opportunity where we can lower the costs and improve access to financial services.
And as we work to do that, there is a lot of talk about overregulation, stifling the market, essentially taking jobs and innovation and offshoring them to places like China, to our adversaries. Do you share that line of thinking that if common sense guardrails move to overregulation, that we may do just that?
Regulatory uncertainty causes market uncertainty. And when the market is uncertain, they will go to where there is regulatory clarity. So if there are other countries with clear frameworks, that is where they're going to head. Or they'll go into shadow banking sector where our regulators would have very little insight and oversight. And so regardless, either way, we'll end up bifurcating our US financial system in ways that will have unintended consequences. A bifurcated system would in fact be part traditional banking and then one part that is in the shadows, if that's where crypto is going. I don't think that would help with our leadership in digital innovation. If anything, this will actually just drive our innovation to other countries that very much want to be the leadership in this space. And they're actually quite jealous of our ability right now of being the leader in coming up with the most innovative products and services in crypto.
Thank you. Thank you, Senator Brett. Senator Smith from Minnesota is recognized online.
Thank you, Chair Brown, and thanks to our panelists for being with us today. My first question is for Mr. Reiner. So some people, I think, mistake crypto for sort of this niche, enthusiasm-driven market. And while that might have once been the case, it's important to realize that it is now, last year, $2 trillion in market value was lost. And I think that demonstrates how mainstream this has been. And I think it is also a good reason to be wary about the risks that this growth poses to consumers and to our economy. And this is why Senator Warren and I questioned Fidelity's decision to offer Bitcoin in 401k plans. And we recently have been pressing regulators about banks' exposure to crypto risks. I start from the place that people are pretty much free to invest their money or to bet wherever they want to, and that includes crypto. But I am really concerned about the potential for these highly volatile assets and risky assets to get into our financial system and what impact that might have if there is a collapse for future crypto collapses. So, Mr. Reiners, in your written testimony, you said that the failure of crypto to fully integrate into mainstream finance is due to a combination of luck and prudent action by a handful of regulatory agencies. Could you talk a bit more about that? Just how lucky were we, and what should we be doing as policymakers to avoid relying on luck as we look at future crises?
Yeah, thank you for that question, Senator. And before I address it, I want to quickly touch on the financial inclusion element that's been talked about in this hearing. There is no evidence whatsoever to suggest that crypto promotes financial inclusion. And in fact, there's overwhelming evidence to suggest the exact opposite is happening. Most people who've invested in cryptocurrency have lost money. Of those people, a plurality are minorities and low-income Americans. Okay, so this is an example of predatory inclusion. We saw the same thing with subprime loans leading up to the 2008 financial crisis, where low-income and minority communities are being explicitly targeted with very, very risky products. And unfortunately, they have lost, in many cases, everything. Now, to your point, Senator Smith, about limiting the connections between crypto and the traditional financial system, we did luck out to a certain extent. I would point back to the fall report from the Financial Stability Oversight Council, and where they said, listen, the crypto market can be systemically risky given two things. One is size. Obviously, the bigger the market, the bigger the risk that it poses to the rest of the economy. And then two is the connections between that sector and the traditional financial system. And the industry has been trying very, very hard to integrate into mainstream finance so that the two are essentially indistinguishable, which I find ironic, given that the whole premise of cryptocurrency was to bypass banks and the traditional financial system. Now they're desperately trying to get access and make themselves seem as if they're legitimate. And they use the same terminology that we're accustomed to with traditional financial institutions, right? So broker, exchange, bank, but they're not. These things have meaning, and they're using these words intentionally because they want you to think that they are regulated and just as safe as these traditional institutions, okay? And in some cases, for instance, Voyager, they were lying about the fact that they were FDIC insured, and then they had a cease and desist order sent to them by the Fed and the FDIC. So I would just, run through the list. You mentioned Fidelity attempting to put Bitcoin into 401ks. Would we think it's okay if they just let Powerball tickets end up in our 401ks? Again, crypto's just gambling. And so thankfully, the Department of Labor has sent out a letter saying that it'd be a violation of fiduciary duty for plan administrators to offer, or that they think it would be a violation of an administrator's fiduciary duty. And that, again, restricted, I'm sure, a lot of employers from allowing their employees to invest in crypto. Look at FTX. They had an active proposal in front of the CFTC that would allow them to offer retail traders 24/7 access to crypto derivatives on margin directly without the need of going through a broker or futures commission merchant. Again, if the CFTC had granted that proposal, as it appeared likely that they would have, this FTX situation would have been very, very different. Again, multiple attempts to list a ETF that tracks Bitcoin. In fact, Grayscale has sued the SEC for not granting them that permission. Again, just think of how many investors would have lost money, more money, if there had been a Bitcoin spot ETF on the market. So we kind of lucked out here a little bit, Senator, because we had agencies, at least some agencies, that were willing to do the right thing, even though in many cases it wasn't popular. And I think going forward, we need to have a clear regulatory framework, as I addressed in my written testimony, to make sure that crypto doesn't integrate into the traditional financial system, because they are continuing to try and they will not stop.
Well, you just laid out, I think, so many of the concerns that I have with this whole with this whole field. And as you say, there's sort of this imprimatur of reasonableness and trustworthiness because of the terms that are used and because of the ways, and as you say, the very typical financial terms that people are sort of familiar with. Yet you take this thing that is supposedly, we've been calling it a digital asset, but it's not clear to me whether many of these so-called assets are not just a bet, because maybe this will just like go back to this for 1 minute. If there's no underlying value, then you are really just betting on whether it's going to go up or go down, whether you're going to win or you're going to lose. And that, I think, is my great concern. And I appreciate your comments on how it does seem to me that in this field there are, there are people that are being, a lot of people that are losing money and are being taken advantage of when they should be know that in this category that there's some basic consumer protections that are going to protect them. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Tillis from North Carolina is recognized.
Thank you, Mr. Chairman. Welcome to all of you for being here. If we take a look at this Congress, you have to kind of sort out what the art of the possible is. Every Congress is a little bit different. We have a divided government here, and while I hope we can look at some big things, I'm really wanting to get down into some singles and doubles. Professor, I heard you talk about an idealized framework from your perspective. That's a big lift and not likely to occur. What I'm also worried about is with the lack of information that we could overreach. And Professor Jeng, you mentioned GDPR. I follow that fairly closely. It was a good, broad regulatory construct that has met with some challenges. They've had to go back and refine it. So I think we need to get it right. So I tend to be more on the lean singles and doubles approach to addressing some of the problems and building over time. I thought that Senator Vance's analogy on the internet was a good one. Now, we have a hearing downstairs right now talking about protecting our children on the internet. We've got a lot of work to do in that space, but I think overreaching could have set us back by a decade or generation of innovation. So one of the things that we've looked at that I don't think would be particularly controversial, but what I would put in the single or double category is a proof of reserves requirement. If we saw that in the FTX world, we could have avoided some of that. So number one, what is your thought, if we can be quick, I want to at least get 2 questions in, but what are your thoughts on things like proof of reserves and other things that Congress can act on? I don't find a lot of comfort in knowing that Mr. Gensler thinks he has full authority to implement a regulatory regimen, because I think he's been going a little bit too fast and a little bit too expansive on rulemaking, which is why I hope that Congress will act so that we get this right. So give me some ideas on singles and doubles.
Yeah, so I appreciate the question, Senator. Frankly, proof of reserves aren't worth the paper that they're written on. And I would just point to the so-called proof of reserves that Binance had from Mazars until Mazars pulled it off of their website and stopped doing any work for crypto.
Is proof of reserves not a worthwhile pursuit? Or
so audits are worthwhile. So I think audits are a worthwhile pursuit. And I think that is a single, certainly, that this Congress should look at. There's no reason that crypto intermediaries, exchanges, should not have full audits. But proof of reserves are not full audits.
We were talking about an independent third party reporting to the Treasury, so I think that may address the point you were making about worth the paper that they're written on.
Yeah, okay. Yeah, and I would say one other sort of single is requiring these crypto platforms to segregate firm assets from customer assets.
Yep. Professor Jeng?
Proof of reserves can be defined a number of ways. At its simplest, it's like balancing your checkbook. Mm-hmm. And you could do that either through GAAP accounting disclosures or on-chain confirmations or supervisory exams. And so whatever method is chosen, it is just about verifying what is on-chain as well as what is off-chain.
Yeah, and by the way, maybe we need to get your opinion, but on the proof of reserves bill that we're working on in our office, we are trying to deal with commingling of customer funds. I think the things that you're getting at, so really making it have teeth, but I'll go to you, Ms. Yadav.
Thank you so much, Senator. Proof of reserves is something that is a ones and twos here to make sure that the methodology is clear, to make sure that the methodology is robust. What that means is that the liabilities are being fully disclosed. One of the problems right now is that it's not clear whether the liabilities that are being disclosed are in fact comprehensive. And so the ability to have third-party audits, as you suggest, that are robust and that are done systematically. In addition, also, we need to make sure that we have the internal controls that go into and underlie the proof of reserve. So for example, it's not enough simply just to disclose. It's important that the actual exchange has internal controls that can make sure that these assets are properly segregated, that the valuation of these assets is done, is marked to market on a very regular basis, and that the proof of reserve disclosures are done regularly. Giving us a snapshot once every 3 months is not going to be enough. These are things that are changing every day. In addition, also, it's not just proof of reserves, it's proof of solvency. Now, one of the things that is emerging in these different exchanges is that many of the balance sheets are made up of these, coins that essentially they are minting themselves, and the valuation there is not clear. In the case of FTX, for example, the FTT token has fallen precipitously in value. The exchange's own tokens, in the case of Binance and others, are constantly volatile. And so making sure that we have not just the disclosure of the reserves, but also making sure that the assets that are being held are liquid and tradable. One of the issues with these assets that are happening here is that the market for trading them is extremely thin. And so the ability for folks to cash out is limited by the fact that the actual exit is much less liquid than a proof of reserve by itself might suggest. So that's another thing that would be important to take into consideration.
Thank you all.
Thank you. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So big-time financial criminals love crypto. Just last year, just in 1 year, crypto was the payment method of choice for international drug traffickers who raked in over $1 billion through crypto, North Korean hackers who stole $1.7 billion and funneled that money into their nuclear program, and ransomware attackers who took in almost $500 million. The crypto market took in $20 billion last year in illicit transactions, and that's only the part we know about. That is a lot of fentanyl and heroin, a lot of help for Iran and Russia, and a lot of money leaking out to terrorists. And that is precisely what anti-money laundering rules are designed to stop. Now, Mr. Reiners, you've studied financial technologies, including crypto, for many years now. And before that, you worked as a regulator. Why do drug lords and human traffickers in countries like North Korea and Iran use crypto instead of banks and credit unions or even Western Union?
Thank you, Senator. So crypto pseudonymity makes it ideally suited for bad actors. And when you couple that with the fact that crypto transactions are not subject to the same AML and countering the financing of terrorism.
AML meaning anti-money
laundering and the countering the financing of terrorism statutes that traditional financial transactions are subject to. Again, that just makes it ideally suited for people that want to do bad things.
So in other words, crypto helps those drug traffickers and rogue states launder money nearly instantaneously. Is that right?
That's correct.
All right. And if they couldn't use crypto, would ransomware gangs even exist?
No.
And why is that?
Because ransomware is the exclusive payment method of choice for ransomware hackers.
You mean crypto?
Or I'm sorry, crypto is the exclusive payment method of choice for ransomware hackers.
100%. Wow. So we have money laundering rules that cover banks and credit unions and stockbrokers and gold dealers and even Western Union. But the current rules don't cover big parts of the crypto industry, and crypto likes it that way. In fact, the crypto industry claims that applying anti-money laundering laws to the whole crypto industry is, quote, not only unnecessary, but it's all but impossible. By the way, this is not a new claim. In 1970, Congress decided it was time for financial institutions to do their part to prevent money laundering, so it passed the Bank Secrecy Act, or BSA. The banking industry objected, claiming that complying would be, quote, a tremendous expense as well as a pain in the neck. The banks resisted. They brought legal challenges. They complained that it would be impossible to comply. And then after the law went into effect, they made it work. now the crypto industry explains that they are amazingly innovative and creative, but they just couldn't possibly figure out a way to comply with the same anti-money laundering rules that everybody else follows. So, Mr. Reiners, do you buy the industry's argument that crypto is simply too special to follow anti-money laundering rules and that it would be too hard for them to even try?
I do not, Senator.
All right. Some in the crypto industry say that anti-money laundering rules can work so long as they exempt so-called decentralized entities, the crypto exchanges, lenders, and other financial intermediaries that run on code. In other words, they want a giant loophole for DeFi written into the law so they can launder money whenever a drug lord or a terrorist pays them to do so. Now, that is exactly what Colorado-based crypto exchange Shapeshift did when it deliberately restructured itself as a DeFi platform. And here's what it told its customers. They said, we're making this shift, quote, to remove itself from regulated activity. Translation, launder your money here. Mr. Reiners, should Congress be in the business of creating loopholes for money laundering?
They should not.
All right. Look, the rules should be simple. Same kind of transaction, same kind of risk, means the same kind of rules. And that's why Senator Roger Marshall and I are reintroducing our anti-money laundering bill to clamp down on crypto crime and to give regulators the tools they need to stop the flow of crypto to drug traffickers in places like North Korea and Iran. Thank you, Mr.
Thank you, Senator
Chairman.
Warner. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman, and I want to thank our witnesses for being here today, including Professor Yadav, who's from my home state of Tennessee and also from my alma mater of Vanderbilt. Welcome to all of you. I think it's imperative that we continue to discuss digital assets because America's national and economic security are greatly enhanced by the preeminence of our financial system. And in order to maintain this immense competitive advantage, we've got to stay abreast of innovation. This involves embracing technological advancements, as unusual as they may seem, in order to preserve our economic strength and our strength as an ally and an enforcer on the global stage. Blockchain technology represents one of these areas of rapid innovation, and rather than incentivize their movement offshore, we should work to foster a safe and certain environment for them to flourish here in the United States. So, Professor Jeng, I'd like to start with you. In your testimony, you highlighted the importance of payment tokens like stablecoins to the digital asset ecosystem. And I agree with this characterization, as not only will these tokens help usher in faster and cheaper payments for Americans, but if allowed to develop, they'll also advance the role of the U.S. dollar abroad. However, as you also mentioned, trust in the assets backing such tokens is crucial. Unless users are confident in what is backing these tokens, their adoption will be severely constrained. That's why I introduced a straightforward and light touch bill last year to set the standard for assets backing stablecoins and to require their issues to publish audited reports of their reserves. So, Professor Jeng, do you believe, like many of those who are hostile to the technology, that only a central bank digital currency issued by the Fed can serve the function of a payment token?
Thank you, Senator, for this important question, because there are certainly different types of ways to transfer value. CBDCs definitely could be one of them.
But not exclusively that.
But not exclusively. What is...
I agree. I want to keep moving because I've got a lot to cover today. What kind of legal clarity would be necessary to help encourage the adoption of stablecoins other than the one that we just spoke about, issued by the Fed?
I think it's very important that we have a clear regulatory framework that utilizes public feedback. What we have been missing has been rulemakings through the public process, and we need public input. Regulators need to better understand the technology and also gather the best ideas out there on how to oversee the industry.
No, you made this clear when you cited the fact that there have only been 2 sort of minor rulemaking activities by each of the SEC and the CFTC, while there have been 30 of these retroactive litigation cases at the SEC and 18 at the CFTC. That is not the way to run things in a rearward, hindward-looking piecemeal basis. Let's turn on now to something that's concerning me very, very much. In the past few weeks, there's been a coordinated chorus of regulators talking about severing crypto from our financial system. To me, this really feels reminiscent of Operation Choke Point, an exercise under the Obama administration that I strongly disagreed with. And in Operation Choke Point, politically disfavored entities, although legal, were cut off from banking services in order to achieve partisan gains. At the same time, I've heard from some of my colleagues, particularly on the other side of the aisle, that they're fine with not regulating crypto. Just let it go overseas and not legitimize it. But to that I say, what happens to the hundreds of thousands of users from Tennessee that are already transacting in crypto? Are we simply not going to create safeguards to protect these consumers? And where do U.S.-based crypto innovators go? To that end, Congress needs to write legislation to properly regulate this industry so we can protect consumers and remain at the cutting edge of a rapidly evolving space. It's becoming increasingly apparent that the SEC isn't going to do its job, so it's on us, now more than ever, to make sure that we have proper safeguards in place and to make certain that another FTX-like event never happens again. So, Professor Jeng, what effect would a wholesale debanking of the crypto industry have on the industry's activity here in the United States and globally?
Please be brief in your answers. We have one more witness, and Senator Scott and I are late to votes. That's our fault, not yours, but be brief with your answer if you could. Thank you.
The crypto industry is an industry that needs access to banking services. If it does not have access to banking, it will either go offshore or into shadow banking, again, bifurcating the U.S. financial system, to which our own U.S. regulators will not be able to see and monitor and regulate those parts of that system where they have fled to. And then if it were to be offshore to other countries, those countries would end up having leadership in digital innovation.
Just like Binance, and Binance will laugh all the way to the bank because they'll fill
Thank you,
the space.
Senator Haggerty. I
Thank you.
apologize for doing that. Senators who wish to thank the witnesses. Senators who wish to submit questions, those questions are due 1 week from today, Tuesday the 21st. Witnesses will have 45 days for to respond to any questions. Thank you again. The hearing is adjourned.